We have had the sharpest interest rate increase in history. Inflation is sky high and the so-called mortgage cliff is on the horizon. Yet, the property market has never looked better. In this video, we bust few myths about inflation, interest rates, and the so-called market crash that's up and coming. And you will want to watch this entire video as we build our case on why we are expecting another property boom in 2025. And if you're not careful, you might miss out on the market by the end of 2023. The first myth we're going to bust is the inflation myth. If you are distracted by mainstream headlines like this one and putting your property plans on hold, you might want to reconsider. This graph tracks the median property price growth against various factors. One of them is inflation. So let's look at the most notable inflationary periods back in 1973, 1983, and the late 90s. In 1973 to 1975, we can see strong price growth in 6 out of the 8 states. The following high inflationary period was 1983 to 1985, and we can see again strong growth in 4 out of the 8 states. And in the late 90s, we had high inflationary periods, and Sydney and Melbourne went gangbusters. It also goes without saying that low inflation does not necessarily mean price growth. So this graph teaches us so much. First, there is no one general market. As we clearly see, different markets perform differently. Second, high inflation means different things in different markets. So you just have to find the right markets to invest in and position yourself in as an investor. Third, and most important, a high inflationary period is followed by a strong boom. We have had high inflation throughout 2022 and it is ongoing in 2023. So 2024 and 2025 are looking very good. Now, if you're worried about the higher interest rates, don't worry. Moving on to the next myth, or the second myth we're going to bust today, is higher interest rates. Some argue that higher interest rates cause market downturns and that low interest rates cause property market growth. But what does the data have to say about this? Between 1988 and 1989, rates increased, yet we still saw a property market growth. Following that, we had a massive drop in interest rates, yet the general market had some sort of a stagnation. Now remember, we established already that there are markets within markets in the first graph, but overall, we did have market stagnation when rates dropped. The most notable period was between 2002 and 2008 when rates increased from 6% up to 9%. Yet, prices doubled in most of the country. And that happened again between 2009 and 2010 when rates increased and so did our property prices. So clearly, interest rates do not determine the growth or the decline of our property market, and that is another myth busted for you today. Moving on to the last myth, and the one that I'm looking forward to bust the most, is the market crash myth. The myth goes, or the conspiracy is, so many borrowers are faced with higher interest rates very soon when their fixed terms expire, and they are not going to be able to afford to hold on to their properties. So they are going to have to sell their properties and we will have oversupply of stock, which will force a market downturn. So the key data that we are looking for here is the amount of stock or properties for sale that are coming to the market. This is what we need to look for. So this graph is pretty much self-explanatory. The data indicates that there is a severe undersupply of properties coming onto the market, not oversupply. So if property owners are struggling, where is the stock? For the market crash myth to be true, listings coming to the market should be more than what they were last year and more than what the average of the last 5 years was. Instead, we are looking at a decline of 22.9% from last year. And 50% of fixed term loans have already expired. So where are the fire sales? I'm still waiting for them. Let's take this another step further and knock this myth out of the park. Look at the auction clearance rates for this year compared to last year. Properties for sale are clearly in undersupply and very little distressed sales are coming onto the market. Where will the market crash come from? If you're waiting, you should know that 50% of fixed home loans have already expired. I would seriously reconsider the strategy if this is what you wanted to do. So these are the 3 myths busted for you today. I would love to know your comments about them. Do you agree? Do you disagree? Let me know in the comments section below. At the start of this video, I said that if you're not careful, you might be priced out of the market by the end of 2023. Here is why. Historically, the market bottoms out when Sydney reverses its downturn and starts recording growth. Other states tend to follow. In the last 3 months, the home value index in Sydney increased by 3%. To put things in perspective and to appreciate the significance of this increase, it's good to know that Sydney recorded a decline or a drop of 13.8% from peak to trough or bottom. So a 3% increase in 3 months is a 21.7% recovery already. Sydney has achieved that in 3 months. If we stay on this trajectory, Sydney will return to its peak prices by end of this year, early next year, and boy, I can't wait for FOMO to kick in. So if you think you have plenty of time and are still sitting on the fence, I urge you to get started. By the time you organize a pre-approval and an equity release, it could be a month or so. Not to mention if you're buying a property under an SMSF structure, it could take up to 3 months. So the window of opportunity is closing fast, and we actually have that data to support that the market is moving very quick. Let's have a look. Supply of new dwellings is falling rapidly behind population growth. And now we have an even bigger gap between supply and demand. The pipeline for new dwellings is also not looking good as approvals plunge to 2.5-year record low. So we don't have enough properties now, we don't have enough properties in the future, and we are expecting massive population growth. The lack of supply has also put huge pressure on the rental market, significantly reducing the vacancy rates to below 1% on a national level. There are markets sitting at 0.5%. Properties are not going to get cheaper. They're not going to get cheaper than this. And the future of our property market is looking good. We're expecting a boom for 2025 for the following reasons. We're expecting interest rate cuts in 2024, which will fuel demand and boost confidence. We have ultra low vacancy rates, which will give confidence to property investors. We have a severe shortage of supply today and in the foreseeable future. And we have record migration numbers coming into the country. So I will say it again, the window of opportunity is closing fast. And if prices continue moving upwards in this current interest rate climate, you might be priced out of the market in 6 months if your income doesn't increase, but rates increase a little bit, for example. And if you have concerns or fears about property investing, it's completely normal. Just take a step back and build your strategy and invest in what works for you today and in the future. That way, you can't go wrong and you will benefit from long-term growth of property. Thanks for watching. I hope you enjoyed this video and I'll talk to you again soon.